According to the Economic Survey 2021 that was presented by Finance Minister Nirmala Sitharaman just before the announcement of the budget earlier this month, India's economy is firmly in the middle of a V-shaped recovery and will bounce back with double-digit growth in 21-22. Although we are experiencing one of the worst pandemics of the century, globally the stock markets are looking up since the beginning of this year. Factors such as COVID-19, vaccine development and administration, economic recovery, amplified fiscal and monetary policy are responsible for this positive spiral. Most businesses across sectors are making attempts to adjust to this new normal and are now finally getting back on track, right? So what does this mean for the Indian investor? How should they invest in 2021 to ensure good returns? How can they carry out proper asset allocation? To answer all of these questions today, we have with us Mr. Mahindra Jaju, Chief Investment Officer for Fixed Income at Mirae Asset. He has over 25 years of experience in the field of financial services and more than a decade experience in the realm of fixed income fund management. Welcome to the Winning Over Volatility interview series, Mr. Jaju.
Thank you so much for inviting me.
I am Raudra Bhattacharya, head of the HT Brand Studio and your anchor today. And our episode will focus upon how corporate bond funds are a great investment choice in the current market. My first question, sir. The Indian economy has crossed this great hurdle and we are, of course, expecting a strong rebound this year. Do you believe that the coming decade will be about economic growth for India riding on the back of domestic consumption and the massive boost for domestic manufacturing that is expected to sort of come as a result?
So I am more than confident. I am equally excited about the prospects for India because India has always been a land of potential. We have had some very meaningful structural reforms during the COVID time. The Atmanirbhar theme that the government has adopted, I think, has worked very well. We have had a very, sensible approach to the COVID management in the sense of focusing in the first phase on helping the people who got affected adversely, and then now the fiscal stimulus package that has come in the, one exhibition of that is the high fiscal deficit, which is projected for the next year, which is largely going into the capex related situation. The more important part is that during the COVID time, we have seen the high quality companies reduce debt. I mean, one would have thought that this will lead to a lot of stress. For the first time, we are seeing EBITDA growth outperforming the expectations. So there is a lot happening, and I think a good ground has been laid for a sustained growth in the next decade and beyond. So I think we should all feel very confident and excited about the future prospects.
Wonderful. So the ingredients are now sort of coming together. The COVID numbers are in control, great. And of course, the fiscal stimulus is expected to boost demand and of course trickle money down into the hands of consumers finally to spend. So in this current scenario, can Indian investors take advantage of these sort of emerging opportunities in the short and long term? And how can one measure performance on returns the right way?
I will restrict myself to the fixed income. And in case of fixed income, we have had one of the most spectacular rally. We just had the lowest ever kind of interest rates, just 3 months back. And the Reserve Bank had adopted a ultra loose monetary policy, primarily with the twin objectives of first stabilizing the financial markets after the COVID crisis broke out, and second to now sustain the ongoing economic recovery, which is still at a nascent stage. And then if you look at the situation today, the COVID situation, I think, is getting more and more normalized with a passing day, because we, for the first time in a long time, we had under 10,000 cases yesterday. The cumulative case count has fallen from about 10 lakh in September to about 1.5 lakh now. 2 vaccines are already there. More are in the pipeline. We have this improvement in COVID situation beyond the peak festive season with elections in many states, onset of winter. So there is a reason to feel confident about improvement in the COVID situation. Economy, after contracting by about 24% in Q1 of FY21, is now expected to grow by more than 10% in FY22. So the two reasons for which Reserve Bank took an exceptional position are now beginning to moderate. And therefore, at some stage, we should expect the normalization of the monetary policy. We have already seen two signals. One is that the RBI started the flexible rate reverse repo, and second is now they did not roll over the CRR relaxation which was given during the COVID time. At the same time, there you cannot rule out a relapse of the COVID situation. So one has to be on guard. We cannot let our guard down, and the economic momentum still needs a lot of hand holding. Fortunately, we are in a very encouraging macro fundamental environment. The global central banks are all continuing to follow an easy monetary policy situation. Headline inflation in India has fallen to 4.09% in January. So there is that extra bit of legroom or the elbow room for Reserve Bank to maintain a easy policy stance. So in this situation, it all boils down to then the supply management of the large government borrowing and to meet the corporate borrowing requirements of the private sector. And I think RBI is very clear in its guidance through open market operations and other interventions. So I think at this point, we are looking at a range-bound interest rate environment. However, in the second half of the year, once you have the inputs on monsoon and how the inflation behaves in an economy which is growing in double digits, possibly there is, because of the higher credit demand, which is a good reason to have possibly some nudge up in the interest rates in the second half. So that's the broad big picture that we see now.
Interesting. So some tightening from the RBI front is slowly expected as we go ahead. I mean, assuming that growth is on track and all the right indicators are there.
Yeah, absolutely. And I think Reserve Bank has done an incredible job in managing the COVID situation. And when the things come back to normal, I think they are very objective people and they also react to how the market evolves. So some tightening or hardening of yields will be in order depending on how the situation evolves. But then one cannot just focus on that. One has to see whether the competitiveness and the profitability and the stability of the system is able to absorb that. And I think that's the only time that will happen. So I think we are very encouraged by how we look at the situation right now. And in the context of the possibility of interest rates going up or the corporate spreads widening because of the crowding out of the private sector borrowing because of the large supply in the system, it will possibly create an opportunity to invest into high quality corporates at attractive spreads because when the economy is growing at above 10% and with a momentum to grow by another 10% in the following year, obviously there will be a larger credit pickup from the corporate sector. For example, we have all been literally, waiting to hear this, that a company like Tisco says that they will now go for doubling the, production capacity. That kind of capex news we haven't heard for a long time. So that's the good part, but obviously it will lead to some sort of, larger demand for credit, which will widen the credit spread. So you are going to possibly be in a fortunate situation where high quality companies are going to borrow at a time when the yields are going up and the spreads are widening. So it will be an excellent opportunity, as I said, to invest in a high quality company and I'm not just saying a particular name, I just give an example of how capex cycle is possibly looking to work up again.
Wonderful, and it completely sort of adds up, right? I mean, and this was really my next question. What are the how do you perceive corporate bond funds as the right investment choice? And you've already answered that. So the second part of the same question, is there a specific category of investors who should be opting for corporate bond funds, in the year ahead and the next few months?
So I believe there are only two categories of investors. One is the category of investors who look at fixed income as an asset, part of the asset allocation of their overall portfolio.
Yeah.
People who look at debt not just to somehow preserve capital, but to maximize the returns on that. So they treat fixed income not as a savings option, but as an income generating option. Then they are the people who are oriented towards long term. They understand that markets are volatile, NAVs will go up and down. So essentially, what I'm saying is people with long term investment horizon, with a objective to maximize the return in the portfolio, they will continue to look at the bond funds as a very attractive option. Uh, History will tell us that those funds have always generated reasonably good returns. Those funds will obviously give you a little bit of volatility because there is no free lunch. And therefore, there are periods, let's say in the next 6 months or in the next 12 months, as we discussed, if let's say the interest rates go up a little bit, one way to look at it is that, look, when the rates go up, my existing investment will suffer a little bit of NAV dip and so on. The other way to look at is that, look, this is not my end of investing career. So if whatever surplus I generate in the current year, that will be then invested at a higher yield. So the key difference between different types of investor is the investors who look to remain invested through a complete interest rate cycle. For them, it is a good opportunity to add to their investments at more attractive or higher yields. And then when this interest rate cycle reverses again and interest rates start coming down, then they will reap the benefits. That is again assuming that the interest rates will go up. At this point, there is nothing to suggest that the interest rate should go up in a knee-jerk or disruptive fashion. And then there are other set of investors who are always making those minute calculations that if the interest rates go up, we will be able to invest at that yield, etc. Now, in case of debt funds, there is a complication in terms of the taxation disadvantage if one invests for less than 3 years at a time. So most of the time, in our experience, whatever advantage you get by thinking too much about the interest rate volatility is wiped off by the tax handicap that you suffer. So my thought is that the investors should look at this as an opportunity, look at this as a market cycle, and focus on eventually ending up with a good experience of investing when this complete interest rate cycle is completed. Like, just to give an example, in 2018, we started with 10-year yield at around 6%, and then it ended at a high of close to 9%, and then we came back to below 6% in 2020. And that resulted in one of the outstanding market performance by debt funds during that rate, notwithstanding the right challenges with the credit fund. So the trick is to basically avoid aggressive credit and not worry too much about the interest rate volatility.
And stay through a cycle. I mean, to see that.
One interest rate cycle, then I think you are looking for a very happy experience.
So what are these different types of corporate bond funds out there on offer for the retail investor, and which one should one look at given the current market situation?
So across the categories, debt funds invest in corporate bonds corporate bonds in different forms. But there's this category called corporate bond fund, where as per the SEBI guideline, minimum 80% has to be invested in corporate bonds of AAA or a minimum credit rating of AA+, which means by default, the credit quality of the portfolio is of a very high order. Yeah. So this is a high quality portfolio. 20% is at the discretion of the fund manager. So most of the time, our core approach is to even invest that 20% in high quality papers. There is a new requirement now that 10% of the fund should be invested in liquid assets. So almost 90% of the fund is invested in very high quality assets. The only challenge in debt is when you lend money and the person to whom you lend money doesn't pay you back in time. That's the time the real challenge starts. So there is a high degree of safety inbuilt into the construction of the portfolio. On top of it, in this category, there is no range of duration within which the fund manager is constrained to invest. So therefore, for those fund managers who have a flexible interest rate strategy, they can reduce the average maturity of the fund when they think that interest rates are going up and vice versa. So it also allows a more flexible interest rate management a more flexible, therefore, risk management strategy by the fund manager. And to that extent, it gives an extra layer of either a participation, in a performing market and a downside protection in case of an adverse or unfavorable market. So this category, therefore, I think looks very, very attractive from the investor's perspective. And then you have different segments of funds like the liquid funds or ultra short term fund, which are largely for transactional or short term surplus money. But this corporate bond fund category, particularly in the current environment where, as I explained, credit spreads are likely to widen, this looks very, very well positioned for now.
So, if you had to compare, it with other debt funds available, how would you rate the credit risk and the liquidity of corporate bond funds?
So, as I explained already, that the liquidity and the credit quality both in this fund is of a very high order. If you look at the trading pattern on corporate bond market in India, almost 80 to 85% of the trading volumes are in the AAA and AA plus category. So, this is the most liquid segment of the corporate bond market. This is the segment again which is the next highest traded segment after the government bond. So this typically a company to get a AA plus rating has to have a very strong balance sheet, strong promoters track record, strong cash flow visibility, good moat around its business. So typically companies with a long-term rating of AA plus are as good as a government company except for the government ownership, because government ownership always gives you a very good rating profile. And therefore, I think this has a very good rating profile. Credit quality of this fund portfolio is very good.
Talking about some sort of macro indicators that might sort of impact the interest rate. So, I mean, inflation, GDP growth, fiscal deficit, or a global sort of geopolitical sort of scenario. I mean, how do you think these factors can affect the interest rate received from the fund? I mean, you already said that credit risk is extremely high rated fund. So obviously exposure in that sense will be.
Look, if you look at the inflation, it's a basically cyclical kind of a parameter, except in countries where there either you have a structural inflation problem or structural deflation problem, like we are seeing in some of the Western advanced countries right now. So it's a typical cycle that when inflation goes up, the central banks will tighten liquidity, they will increase interest rates, and then it will in turn affect demand, and therefore in turn the inflation will begin to ease. And when the inflation eases, again the demand increases, the liquidity increases, and then the same. So this cycle plays out. We saw that inflation was 7.61% in September, and now it is 4.1%. So food items are very volatile in nature. We are right now seeing a sequential increase in the oil prices for the last 1 year. The oil prices are continuously going up. There is a sustained rally in the commodity prices. So commodity prices are at multi-year high now. So these are cycles, and then they change. So interest rates go up and then they come down, which is why I spoke about one complete interest rate cycle. The best experience in a debt fund will come when the investor sits through one complete interest rate cycle. Now, at this point in time, my sense is that we are in a very stable macro fundamental situation where the inflation is now at the lower bound of the Reserve Bank's target, although the core inflation is still around 5.5%, which is on the higher side. But when the inflation was at 7.5%, there was a certain amount of nervousness and edginess. Today at 4%, that is, I think, largely addressed. Because of the stable and supportive global environment, it provides a little bit of extra room for a accommodative monetary policy. Why at this point, it's largely a supply management issue, because the government borrowing program is rather large to support, to provide a fiscal stimulus to the economy. So in this benign environment, I think, and the Reserve Bank's guidance is amply clear that they would intervene through open market operations, etc. And therefore, I think the interest rates will remain largely range bound. Get into the second half of the year, there are two challenges. One, there is a inflation story or inflation narrative being accepted widely in the global markets. In the last 8 to 10 years, the excess liquidity, low interest rates were largely a function of the monetary policy-led quantitative easing without the underlying economic demand or credit pickup. So, like in our case, we have the surplus liquidity of about 6-7 lakhs crores in the system now, but it's largely parked with the Reserve Bank in the absence of credit pickup. But in this round, since the COVID, there has been a huge fiscal expansion by the governments. All governments within their means, like in US, in Europe, even in India now, there is a large government spending which has gone to first support the economy and then to continue help the economy recover. So this fiscal expansion may filter through the broader economy and therefore lead to inflation. Therefore, so one of the strongest exhibition of this belief of resurgence of inflation in the developed world is reflected in the 10-year US yield now going to close to 1/4 from a low of 0.35, even as the Fed remains as accommodative as it was ever. So what explains this increase in the US yields by almost 1%, or they have almost tripled from their low, is the belief that the inflation will bounce back because of the fiscal nature of this round of quantitative easing. So if those things play out, if you don't get a good monsoon, if your current account deficit widens, if the imports pick up again as the economy, so, and some of those things are going to happen in one form or the other, then there is a possibility that then forced by the high supply, the interest rates may go up in the second half of the year. So that's how I think we are looking at the big picture right now.
And what about global headwinds? I mean, you did mention the Fed policy and how that's sort of panning out. But how do global headwinds sort of impact India's interest rates? Oil prices, you touched upon that as well, right? I mean, that's on a high.
Look, India is a country with a current account deficit. So whenever there is turbulence or disruption in the global financial markets, Indian markets are affected. I think right now the global central banks are committed to easy monetary policy stance. Although some in pockets of the developed market, we are seeing a concern on inflation, therefore the bond yield is inching up. Eventually, if the inflation doesn't pick up, then the central banks will anyway continue to remain accommodative. Even if the inflation does pick up a little bit, for example, the US Fed has already said that they would now not take a chance having not seen the inflation go above 2% for some time. They would rather see inflation cross 2% and then initiate any action. And therefore, I think in the foreseeable future, we continue to see easy monetary policy tailwinds for the Indian market. The global environment is likely to be awash with liquidity, so we will continue to see strong FPI growth. So, which is what
money,
gives the Reserve Bank a little bit of extra elbow room to maintain an accommodative policy. So we saw in the earlier part of the year when inflation went to 7.5% also, we were able to guide us for a accommodative policy because the macro fundamentals were supportive when the global environment was supportive. So to that extent, I am not particularly worried about a sudden switch in the monetary policy stance either of global central banks or of Indian, which is why we have more like range-bound interest rates now.
So my last question is essentially to do with the portfolio and how do you sort of as an individual decide how much to allocate to corporate bond funds? What should be probably a checklist on your mind to ensure that okay, this much of my portfolio should be corporate bond funds, and is there any minimum amount bracket for an investor that needs to invest in these funds as well, and what kind of a horizon should he be looking for? I think you mentioned the horizon in terms of an interest rate cycle, but yeah, the first part.
So in our reckoning, first of all, the money that the investor thinks he will not need for the next 3 years or more, that is the one which can come to the bond part or the long-term part of the fixed income allocation. So in my view, about 60% of his long-term overall fixed income portfolio can come to the long-term segment, and there I think it can be divided between the banking PSU debt fund category and the corporate bond fund category in equal proportion. So I think largely investors with long-term investment horizon, typically 3 years or more, can get into the corporate bond fund. And in terms of diversification, maybe split equally between banking PSU debt category and corporate bond fund.
Thank you, sir. Thanks for your time today, for sharing your perspective on how the economy is on the road to recovery and what it means for our investors.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.